Starting September 1st, Baidu will convert its Hong Kong Stock Exchange listing from a secondary listing to a dual primary listing. That phrase sounds technical, so here's the plain version. Baidu used to have a backup listing status in Hong Kong. Now it's becoming a full primary listing in both Hong Kong and US, equal legal standing in both markets. So here's the question. Back in February, Baidu announced something big, a share buyback program worth up to $5 billion, and its first ever dividend policy. Then in August, shareholders approved the dual primary listing. Baidu says the move will broaden its investor base and increase flexibility to access both the Hong Kong and the US capital markets. The conversion itself doesn't involve issuing new shares or raising capital. So the real question is, why did Baidu do two things in 6 months that seem to point in opposite directions? What's actually going on? Let's start with the money. According to Baidu's Q2 2026 earnings, free cash flow came in at negative 7.95 billion RMB, compared to negative 4.68 billion RMB in the same quarter last year. The gap is widening. That's zooming out to the full year. In 2025, Baidu's free cash flow flipped from RMB 13.1 billion in 2024 to negative RMB 15.09 billion. Does that mean Baidu is out of money? Not really. As of the end of June, Baidu still had RMB 283.1 billion in cash and investments on its books, and Q2 operating cash flow was a positive RMB 3.436 billion. What's actually changing is the old business model. Baidu used to rely on search advertising to generate steady cash, then funnel that cash into newer businesses. That playbook is getting harder to sustain. Meanwhile, AI is stepping up to carry more of the weight. The numbers tell the story. Online marketing revenue came in at RMB 13.1 billion, down 19% year-over-year. Legacy business revenue, under the newly reclassified reporting, was RMB 10.4 billion, down 23%. AI business, by contrast, hit RMB 12.5 billion in revenue, up 25% year-over-year, now accounting for half of Baidu's core business revenue. Of that, AI cloud infrastructure revenue was RMB 7.3 billion. AI revenue is growing, but spending is growing faster. Capital expenditure in Q1 and Q2 of this year came in at RMB 5.92 billion and RMB 11.39 billion respectively. Q2 spending was nearly triple the same period last year. Combined first half capex of RMB 17.3 billion has already surpassed all of last year's RMB 12.07 billion. In other words, the cash cow of the old business is receding, while the new businesses keep getting more expensive. Compute infrastructure, large language models, applications, Quantum chips, and autonomous driving, all of these fronts still need continued investment. Has Baidu abandoned the capital logic of a mature internet company? Not at all. The buyback itself is still meant to prove to the market that Baidu remains a company with ample cash, one that can buy back shares and pay dividends. At the same time, though, Baidu's reliance on external financing is clearly increasing. In 2023 and 2024, cash flow from Baidu's financing activities was a net outflow of RMB 14.2 billion and RMB 13.8 billion, respectively. In 2025, that number flipped to a net inflow of RMB 17.1 billion. That includes 10 billion RMB in senior unsecured notes and $2 billion in exchangeable bonds, with net financing from long-term notes for the year reaching RMB 20.8 billion. The related financing announcements don't explicitly say this money is earmarked for AI, but at minimum, it signals something. Baidu has resumed using external financing tools more actively. And the dual primary listing is another step in that same direction. Beyond broadening the investor base and improving Hong Kong stock liquidity, Baidu specifically pointed to one more benefit. The conversion increases its flexibility to access both the Hong Kong and US capital markets. So here's the picture. On one side, a share buyback program worth up to $5 billion and the first ever dividend policy. On the other, rapidly rising capex, consecutive quarters of negative free cash flow, and growing reliance on external financing tools. Baidu is essentially running two capital logics in parallel, one rooted in the mature internet company playbook, the other closer to how an AI company operates today. Baidu's AI footprint is broad, spanning nearly the entire chain from chips to applications. Kunlun chips, AI Cloud, the Ernie large language model, Search and AI agents, and its autonomous driving service, Apollo. But based on the latest earnings, the clearest growth right now is concentrated in AI infrastructure. Q2 AI Clouder infrastructure revenue grew 50% year over year, while AI applications revenue grew just 3%. That's the double-edged nature of full-stack AI. On one hand, Baidu holds more technology and business chips than most. On the other, it also has to fund more fronts simultaneously. How much longer can the old business support these investments? And among the new businesses, which one can actually pull off a second curve and become the next cash cow? Based on what's publicly disclosed, there is no clear answer yet. This problem of AI getting more expensive isn't unique to Baidu. Alibaba is facing the same question. The data shows Alibaba's AI cloud business is still growing. In its latest quarter, Alibaba's AI cloud and computing services revenue hit RMB 48.44 billion, up 45% year over year, and AI-related product revenue reached RMB 12.38 billion, marking 12 consecutive quarters of triple-digit growth. The cloud business's EBT margin is also improving. But the question Alibaba now has to answer is, for an AI cloud business that's already proven its growth, how much more should it keep pouring in? Alibaba's answer has been pretty direct. This past August, it raised HKD 80 billion through a further share placement and explicitly committed all of the net proceeds to AI, about 60% toward global compute infrastructure expansion, and the rest toward hyperscale AI data center construction and cloud infrastructure upgrades. Alibaba has clearly shifted its capital allocation priorities toward AI, scaling back buybacks, opting for direct financing instead, and channeling the new capital into a relatively clear AI plus cloud strategy. Now that capex keeps climbing, the question Alibaba has to answer is how long until this investment pays off? Back to Baidu. Having entered the AI race more than a decade ago, Baidu has barely missed a beat, from chips to large language models to autonomous driving. Back when search was profitable enough, running multiple lines of investment wasn't really a problem. But now, with search revenue declining and capital investment intensifying, each of Baidu's AI business lines increasingly needs to prove which one truly deserves continued funding. The dual primary listing won't directly bring Baidu new financing, but it does increase its flexibility to tap both capital markets. Baidu's more immediate tension right now is this. It needs to maintain the shareholder returns expected of a mature internet company, while also preserving enough capital room for increasingly expensive AI investments. That's it for today. For more in-depth coverage of robotics and hard tech, follow the fourth wave on WeChat and video account. See you next time. Disclaimer: the content and the views in this piece are for reference only and do not constitute investment advice. Investing involves risk. Proceed with caution.